is Eddie Tofpik. I'm Head of Technical Analysis and Senior Markets Analyst at ADM Investor Services International Limited, and here is your weekly technical analysis of LME 3-month nickel and zinc. LME 3-month nickel. The core pattern over last summer and going into winter here that driven prices higher had been the July to November ascending triangle. In November last year, the market broke up over the flat upper trend line of this pattern, which is also the August 2011 high, at 25,195, and also ploughed up through the nearby long moving average, currently 25,450. The market continued higher and exploited the move, with prices pushing up through and closing over the May 2011 high at 27,330, the April 2011 high at 27,950, the recent 50% Fibonacci line at 29,470, and in early December last year, reaching up to breach the 50% Fibonacci line of the March 2020 to March 22 move at 32,945. By then, the market also managed to reach both the primary and secondary targets for the ascending triangle at 3070 and 32,160 respectively. There was one other factor I spoke about last year and something I'd like to revisit. I said 9 weeks ago and since, and I quote, "We had another bullish factor late 2 weeks ago," so that's now 11 weeks ago. It was a bullish bow tie formation, the short moving average currently at 28,315, short medium moving average currently 27,755, and the medium moving average currently 25,465. Now, bow tie formations have two elements. The first is that the market moves in the direction of the exiting moving averages from the bow tie crossover. In this case, it was upward, and that proved to be the case. The second is that between 15 to 20 sessions after the crossover, in this case, this would be between the 25th of November and the 2nd of December, we ought to see the beginnings of the next major move, and it is usually in the direction of the moving averages, or upwards as well. Thus, I would ask you to look out between those dates, especially to gauge what is happening. End of quote. Well, we can easily see that the market continued its bullishness and peaked out only a few days after the window on the 8th of December. Yet in this peak were the seeds of its own demise and of another possible pattern, as the session, despite the highest market since April, ended up as a combined bearish dark cloud cover pattern, bearish closing black mirror bozo, and a shooting star pattern, type 1 bearish. Prices subsequently fell to the May 2011 high at 27,330 before recovering. But though the recovery looked good, it soon petered out at the turn of the year when prices reached the admittedly significant Fibonacci congestion at 32,125 and 32,285. The decline we next saw was faster than the rise, and it looked like we may see prices drop down through all the moving averages and test the extension of the lower trend line of the original ascending triangle. That's currently at 25,315. However, that did not happen. Instead, prices were turned back up by merely the approach to the long moving average 2 weeks ago. And here comes the latest twist. The following move higher has seemingly only managed to get as far as the 50% Fibonacci line of the March to July move of last year at 29,470. This leaves us with an interesting if complex situation. You see, one could look at the whole of the November to date action as a possible complex head and shoulders top with a split head. It will all now depend on whether the market first makes a move down to the proposed neckline of the pattern, currently at 26,415 and highlighted in dark blue, and then what it does when it gets there. LME 3-month zinc. There's a hell of a lot going on here, which just about describes all the multicolored trend lines and patterns seen here. Back in November last year, the market broke down through the lower time, currently 28.76, and highlighted in bright red of the big old 2015 to 2020 bullish Andrews pitchfork. However, this was repaired within a week, and it continues to hold up the market along with the congestion between 27.91 to 28.25, which included the June 2021 low at 28.10, the July low for 2021 at 29.06, and the August 2021 low at 29.17. All these played their role in supporting the lower time and the market. At the end of November, prices pushed up over the middle time, currently at 29.19, which is highlighted here in purple, of the more recent late May, mid-August bearish shift pitchfork, and using it as a base to push up over the flatlining medium moving average, currently 31.22 and reaching up to the 50% Fibonacci line of the March 2020 to March 2022 move at 33.29. Yet prices failed there and moved back down to the middle time, highlighted here in purple. In all this action from September to December last year, we saw the construction of a reverse head and shoulders pattern. The neckline, currently at 31.85, is highlighted in green. Anyway, prices hesitated over the middle time, as well as the support base around the April 2019 high at 29.59, and a combination of the August 2021 low at 29.17 and a July 2021 low at 29.05 before moving up through the neckline 2 weeks ago. Last week prices moved up over the declining low moving average, currently 33.08. And by the end of last week and into the start of this week, the market was up testing the upper time, currently at 34.55. And that's in purple. So far, this has managed to cap the market, as we've seen two indecisive declining patterns and probably a third today. So what has that left us with? Well, firstly, I've previously spoken about the reverse head and shoulders pattern, and this deserves some indicative targets. Therefore, a primary target X1 would be in the 35.47 area, and a secondary harder to reach target X2 would be in the 36.95 area. If the market does not revert back up and breach the upper time, then target X1 is doable. Next, we have something I've spoken about a lot. It is the March 2020 to June 2022 ascending expanding wedge pattern, currently at 39.95, that's the lower trend line, with the upper trend line way up off the top of my daily chart. So far it doesn't matter. Anyway, the lower trend line is highlighted in dark blue, and that's in the upper part of my daily chart. There are some outlandish potential targets for such a long dated and wide pattern, so to keep an element of realism here, I would suggest only looking at just the possible primary target X for such a pattern, and that is in the 25.45 zone below. This is one to put in the back of your diary and be reviewed maybe once a year or so. However, any failure of the rally from the reverse head and shoulders may highlight this longer term pattern. This leaves a shallowly bearish recent late May to mid-August bearish shift pitchfork, the purple one. Now recently we've seen the middle time with some finessing hold the market up, and the upper time seems to be a good source of resistance right now. I'd suggest waiting a little more to see if there is anything more to be added to this, as it holds some interesting opportunities. It is after all the middle time, a support right now in what is gently sloping bearish market, and until something else shows up, it may be the most interesting thing to watch. Thank you for listening. This weekly broadcast gives the essential market patterns and consequences. Please be aware of the risk disclaimer posted both at the front and the back of this broadcast. Copyright is Eddie Tofpik and ADM Investor Service International Limited. And here comes the final important bit.